Discover how smart planning for dividend taxes can significantly boost your long-term compounding returns and help your investment portfolio grow faster. If you're investing for passive income, you probably know how rewarding dividend stocks can be. But did you know that the way dividends are taxed could make or break your long-term wealth growth? Today, we'll break down how dividend taxes work, how they impact your compounding returns, and simple strategies you can use to keep more of your money working for you. This is not financial advice. Always do your own research or consult a professional. Let's get started. First, why should you care about dividend taxes? Most new investors focus on picking the right stocks or finding the highest dividend yield. But it's easy to overlook taxes. The truth is, dividend taxes can quietly eat away at your returns year after year. Over time, even a small difference in after-tax growth can add up to thousands or even tens of thousands of dollars. Think of it this way. Every dollar you lose to taxes is a dollar that can't be reinvested and compounded. And the power of compounding is what makes long-term investing so effective. So, understanding dividend taxes isn't just about saving a little money. It's about maximizing your wealth-building potential for years to come. Let's break down what you need to know. First, what exactly is a dividend? A dividend is a payment made by a company to its shareholders, usually from its profits. Companies that pay dividends tend to be well-established and financially healthy. When you buy a dividend stock, you're entitled to a share of those company profits, paid out as cash on a regular basis, often every quarter. The percentage of your investment you receive each year in dividends is called the dividend yield. For example, if you own a stock worth $100 and it pays $3 a year in dividends, the dividend yield is 3%. Another key term is payout ratio. This tells you what percentage of a company's earnings are paid out as dividends. For instance, if a company earns $1 per share and pays out 50 cents in dividends, the payout ratio is 50%. A sustainable payout ratio is important for long-term dividend growth. Now, let's talk about taxes. Not all dividends are taxed the same way. In the United States, for example, there are two main types: qualified and ordinary dividends. Qualified dividends are usually paid by U.S. companies or qualifying foreign companies, and you must hold the stock for a certain period to get the lower tax rate. These are taxed at long-term capital gains rates, which for most investors means 0%, 15%, or 20%, depending on your income. Ordinary dividends, on the other hand, are taxed as regular income, at your marginal tax rate, which could be much higher. Here's a simple example. Let's say you receive $1,000 in dividends in a year. If those are qualified dividends and you're in the 15% tax bracket, you'd pay $150 in taxes and keep $850. But if those dividends are ordinary and you're in the 24% income tax bracket, you'd pay $240 in taxes and keep only $760. That $90 difference might not seem like a lot, but remember, if you reinvest those dividends every year, the gap widens over time because of compounding. Let's see how this plays out in the long run. Imagine you invest $10,000 in dividend stocks with a 4% yield, and you reinvest all your dividends. If your dividends are taxed at 15%, and you earn 4% before tax each year, your after-tax return is 3.4% per year. After 20 years, your investment grows to about $19,500. But if your dividends are taxed at 24%, your after-tax return drops to 3.04%. Now, after 20 years, your investment grows to only $18,200. That's a difference of $1,300, just from the tax rate. Over 30 or 40 years, the gap is even bigger. So, what can you do to reduce the impact of dividend taxes? Here are 3 practical strategies. First, take advantage of tax-advantaged accounts. In the U.S., accounts like IRAs and 401 (KIAs) let your dividends grow tax-free or tax-deferred. When you invest through these accounts, you generally don't pay taxes on dividends each year. Instead, you either pay taxes when you withdraw the money, or in the case of Roth accounts, not at all if you follow the rules. This allows your dividends to compound without the annual drag of taxes. Over decades, that difference can be huge. Second, pay attention to the types of dividends you're earning. Whenever possible, aim for qualified dividends instead of ordinary ones. Most large U.S.-based companies pay qualified dividends, but some stocks like certain real estate investment trusts, REITs, Business development companies or foreign stocks might pay dividends that are taxed as ordinary income. If you want to own these, consider holding them in a tax-advantaged account to minimize the tax hit. Third, diversify your sources of income. Diversification means spreading your investments across different companies, industries, and even types of income. Not only does this help reduce risk, but it can also help you manage taxes. For example, you might combine dividend stocks with growth stocks, bonds, or real estate. This way, you're not overly reliant on a single source of taxable income. Let's quickly recap the key terms we covered today. Dividend yield is the percentage of your investment you get paid in dividends each year. Payout ratio shows what portion of a company's profits go to dividends. Diversification is about spreading your investments around to lower risk and potentially reduce your tax burden. Ultimately, the impact of dividend taxes on your wealth comes down to a simple principle. The less you pay in taxes now, the more you have to reinvest, and the faster your money can grow over time. Small tax differences may not seem important in the short run, but over decades they can make a major impact on your final wealth. So, be mindful of where you hold your dividend stocks, pay attention to dividend tax rates, and take advantage of tax-advantaged accounts whenever possible. It's all about letting compounding work its magic, with as little friction as possible. If you found this video helpful, consider liking, subscribing, and leaving a comment below. Have questions about dividend investing or taxes? Drop them in the comments and I'll do my best to answer. Thanks for watching, and remember, smart tax planning today can make a big difference for your future wealth. This is not financial advice. Always consult a qualified professional before making investment decisions.